Mining heavyweight Vedanta is delisting its shares from Indian bourses. Hexaware and Allcargo are among other big companies that have opted to delist their shares from the Indian exchanges in 2020. These companies have decided to delist their shares as COVID-19 pandemic keeps the market on edge. But what is delisting? In simple terms, delisting of securities means removing the shares of a listed company from a stock exchange. Consequently, securities or shares of these delisted companies can no longer be traded on that stock exchange. Delisting could be voluntary or involuntary. There are various reasons for delisting. Companies decide to delist their shares when they cease their operations, declare bankruptcy, merge, seek to become a private company again, or does not meet listing requirements. Companies voluntarily delist when their promoters wish to expand their operations or decide to restructure the business or the company gets acquired by some other company. Promoters may also choose to delist if they wish to raise their stake in the company. So what it takes to delist a company? For any company to delist successfully, its promoters need to acquire at least 90% of company shares. Delisting is done through an exit mechanism which was put in place by the SEBI in 2009. But even before delisting is officially announced, it should be approved by a resolution of the board of directors of the company. Next, a prior approval from public shareholders has to be taken. Companies at this point cannot hide anything from the public shareholders and must disclose all facts and explanatory statements related to the delisting. A company can only delist when twice the public shareholders have voted in the favor of delisting the company than the number of shareholders who voted against it. The board of directors then appoint a merchant banker to oversee due diligence and seek approval from the stock exchange. What is the process of delisting in India? After the approval of shareholders, it is time for the process of reverse book building with the stock exchanges. In the reverse book building exercise, shareholders quote a price at which they are willing to tender their shares. The book is kept open for 5 working days. For example, in the case of Vedanta, reverse book building process began on October 5th and concluded on October 9th. All these quotes are aggregated and a final price is announced on the last day of the book building exercise. This price is called the discovered price. Now the company board will have to accept or decline this discovered price within 5 working days from the closure of the book building exercise. If the company's board is not happy with this final price, they can opt to announce a counter offer which will be higher than the price initially offered. What price is paid to the public shareholders during delisting? Once all the stakeholders and regulators give their approvals for the delisting, a floor price is calculated using a SEBI formula. The floor price is the base price at which the promoters intend to buy back their shares from the public shareholders. The final delisting price is always at a premium to the floor price. For instance, when SR Oil delisted, the set floor price was Rs 146.05 paise. However, by the time the final discovered price came, SR Oil agreed to pay Rs 262.80 per share. This was an 80% premium to the floor price.